Another area that we're going to discuss in greater detail in this course is the role of financial markets for financial management. And when we talk about financial markets, the participants in financial markets are quite diverse. They're public government and public in the sense of publicly owned corporations, as well as private enterprises and governmental institutions that all meet together in financial markets. Various governments raise money through financial markets by borrowing, for example. And corporations also access financial markets through the issuance of bonds and bond and stocks. One of the features that financial markets allow us, let's take for example the stock market as one example, is that they allow managers of corporations to gauge how shareholders feel about and value the current activities of the corporation. Likewise, bond prices tell managers something about how the market perceives their risk level to be. So financial markets are monitored by financial executives within companies to get a better understanding of what the expectations and satisfaction level is for the various owners of debt and equity. And it may influence decisions they make. For example, if the price of issuing new debt goes up for a company, that's probably an indication that they need to reconsider large investments that they're going to make, because the cost of making those investments is going to be greater. The cost of borrowing the money is higher. So just by monitoring the cost of debt, changes are made in financial decisions within the corporation. The structure and functions of these financial markets, we really have sort of short-term and longer-term markets. Money markets deal with short-term securities that have a life of less than 1 year. The large corporations sell commercial paper that is used to finance daily operations in these money markets. Likewise, certificates of deposit or CDs with maturities of less than 12 months are issued by banks. Governments, the U.S. government issues 13-week Treasury securities, raising money in these short-term markets. There are also longer-term markets. We refer to these as capital markets as opposed to money markets. The capital markets are defined as those where securities have a life of more than a year. Among the markets that are included in capital markets are markets for common stock and for preferred stock, as well as the bond market for both corporate and government bonds. These markets are important institutions of capitalism in that they are the mechanisms by which principal mechanisms by which capital is allocated to the parties who are best able to use the capital. So a company that has a good opportunity can raise money through the capital markets, whereas a company that is wasteful would find it very, very expensive to raise capital, because parties would be unwilling to, investors would be unwilling to supply that capital to those companies. So the mechanism by which capital is raised by companies is through what's referred to as the primary market. So when the corporation uses the financial markets to raise new funds, these are done through what is referred to as the primary market. So let's say they issue stock. Now, after they issue stock, shareholders buy and sell that stock, not with the corporation, but among themselves. And that's referred to as a secondary market. So the secondary market occurs for stocks that have already been issued. You know, as an analogy, you might think of a monopoly game. In the game of Monopoly, when you land on a particular piece of property, you can buy the property from the bank. After that, people can trade those little pieces of paper among themselves in the game. They're, for the most part, not sold back to the bank. So there's a secondary market, in essence, that arises of people trading those monopoly properties among themselves rather than the primary market where someone buys it initially from the bank in that case. Well, in the case of companies, they issue their stock initially. After that, there's a lot of buying and selling that takes place among the trading, the investing public in the secondary market. It's worthwhile to recognize that there's been a significant internationalization of financial markets. That allows U.S. investors to invest in companies and in governments abroad. If you want to buy a Japanese bond, you can do that here in the United States. Likewise, a great deal of stocks and bonds sold in the United States are owned by governments and by individuals in foreign countries. That's had a significant impact on corporations, in particular large corporations now find a need for financial managers to understand international capital flows. And they need to understand how to trade foreign currencies. They need to understand hedging strategies for those foreign currencies. So the internationalization of financial markets has led to a need for greater sophistication on the part of financial managers.